Hey guys, welcome to episode 13. This is part 13 of the tutorial on Python stock analysis, value investing stuff. Okay, so now we're getting to the more nitty gritty details of the stocks, right? Like we're going to look at the more complex stuff. So far, we've been looking at just simple charts and graphs, but now we're going to take a look at some more in detail stuff, right? The first thing you got to watch out for are ratios and trends, but not just trends, but in terms of percentage change. So the first thing about ratios, I don't know if you guys heard of these like current ratio and quick ratio. So basically, where's the formula? Yeah, so like current ratio is what you own divided by what you owe, right? So you want the current ratio to be high, right? Like you want to have more stuff than you owe, right? Like you want to own more stuff than you owe. Quick ratio is different because it's the same, but they just take out inventory. The reason why they take out inventory is because what you own, but it's an inventory, it's not like, nothing's going to make you rich, right? It's inventory, like you have to sell it. So quick ratio is basically a way of saying like, how healthy is your balance sheet, right? So like these ratios are, quick and dirty. Like let's take a look at like AT&T, right? If you go to AT&T stock, which is T, and then you click on statistics, you can see all this stuff. The thing about these ratios, right? Ratios are like snapshot, right? It's like you go into a doctor and say like, your annual checkup, and you ask the doctor like, "Am I healthy? Yes or no?" Well, he doesn't know, right? So he's gonna do a diagnosis on you. So he's gonna measure blood pressure, measure your temperature, like weigh you and check your height and check your breathing and stuff like that. Now, do these things alone mean that you're healthy? No. I mean, the patient could have cancer, could have diabetes. I mean, you don't know, right? So these ratios don't mean anything because it's a snapshot in time, and you have no idea until you like really look in details and like do a diagnosis on this stuff. So like ratios are sort of a quick way to kind of screen out for sort of determine if whether or not you should kind of, if this is worth it. Like for example, AT&T, right? It looks not bad. Like PE, forward PE, price to earnings, which means like PE means price to earnings, right? So like for every dollar of earnings, like how much are you paying? So you're only paying $7. That's good. Like traditionally, it's like people, these value invest type guys, they look for 15 or lower. So it's 7. So it's not bad. Price to book, you only pay $1.09. Let me highlight for you guys. 109, right? That means for every dollar of things that AT&T owns, you only pay $1 for it. That's good. But if you look deeper, right? Like if you just go off of those two ratios, like, oh, it's good, let me buy it. Well, problem is, if you go scroll down, there's all kinds of stuff. Like this quarterly revenue growth, right? It's -5. Okay, so that's not good. Debt to equity, 115. That doesn't seem that great if you ask me, right? And other stuff like let's take a look at the price over time. Like 1 year, okay, it doesn't look bad. 5 years, oh, what's going on? If you look at this, right, their stock now is no different than what year is this? 1995. Right, 1995. Their stock is the same price as it was 1995. I'm sure they had like stock splits and stuff like that, but in general, it doesn't seem like just look at this stock going up and down, left, right. I mean, is this good? I don't know. It depends on like what you're looking for, right? Like if you're looking for dividend, right? They pay 8% dividend, which is pretty phenomenal, right? But if you live in U.S., a lot of people don't necessarily like AT&T that much. Like Verizon, I mean, they're doing better, I think. Yeah, see, their chart is like generally up, but their PE ratios, like these ratios alone can't tell you if a stock is good or bad. That's the bottom line. You have to look at many things. It's not just like one thing. It's like price earnings. That's it. Like that's all they talk about, right? Price earnings on like CNBC. That's all they talk about. It's like, come on, like if it was as simple as just looking at price to earnings to make a financial decision, like then we would need all these like finance gurus and stuff, right? Everybody would be Warren Buffett. Unfortunately, that's not the case. Another thing, so there's things that you want to look at, like basic stuff like debt to equity. Debt to equity is important because a lot of companies, especially like these older established companies, where the founders have like left, right, and professional management companies have come in and take over. These guys basically get, in my opinion, this is my personal opinion, but they basically do a lot of financial engineering to keep their stock as stable as possible, like dividends, stock price. Like they don't innovate. They take a fat salary. All right, let's take a look at that Yahoo lady, the lady from Google that went to Yahoo, right? I don't know what she did. Like she joined the Yahoo company at like when the stock was like 40 something, and then when she left, it was like I don't know, like less than half or something like that, right? And they gave her a fat severance, like $100 million. Like, I mean, would you give $100 million to somebody who lost $1 billion? I mean, that makes no sense. So a lot of these companies they take on a ton of debt, right? Because with debt you can do a lot of things. Like you can pay your investor, which in my opinion is I mean that's as scammy as can get, in my opinion. Well, that's not true. I say that with a caveat. They can do a lot of things, but it's what they do with it, right? So a lot of these companies, big companies, they start not innovating. They just like they're content. Like GE, look at GE for example. Like GE, right? GE was like one of the most innovative companies. I mean, at least that's what I was told. I don't know if that's true, but take a look at their stock, right? It's like, what year is this? This is like their stock is at 1996 level. Like, I mean, if they're so innovative, like what happened, right? Well, that's because when you get fed, right? This effect occurs, which is that your hunger, and hunger is what drives motivation and innovation, right? Your motivation just kind of dies, right? This is why innovation don't come from rich people, come from small guys and like startups and like guys are basically hungry, right? So these big companies, the way they sort of generate more yield, like more cash flow, more profit, is by taking debt, buying companies, or just doing all kinds of like expansion stuff to make their numbers look good. But it might be bad, right? It might not be great. Like AT&T bought Time Warner, right? I mean, was it good? I don't know. In my opinion, no, because it just tanked the company, right? Like basically, Yahoo took on this debt that they can't serve. I mean, they can service, but they took it on assuming that they're gonna have market dominance. But I don't know. There's all these other guys now, right? Like Boost Mobile, like AT&T, not AT&T, T-Mobile and Sprint, and all these like burner carriers. I don't know if you guys know what that is. Basically, they buy the cell phone wires, but they just basically they're just sales and marketing companies, right? So like these guys that you never heard of, like Net 10 or something like that. Anyway, there's lots and lots of competition out there, right? So you have to look at everything in like sort of in totality. So another thing you want to take a look at is percent change. So it's not just a chart going like bottom left to like bottom left to how do I my finger like anyway you get the idea, right? You want it to be like my finger is like you want it to be like this, right? Left bottom left to top right, but that doesn't necessarily be the case because it's a percent change that matters, right? So the theory is that if your company is doing well, like your profits don't go from 1 million to 2 million to 3 million to 4 million, because that's just like 1 to 2 million is 100%, but 2 to 3 million is only 50% increase, right? So theoretically, your percentage should be going up as well too. So not only that, free cash flow, revenue, net income, your return on invested capital, and your debt to equity should be going down, right? So these are percent changes that you need to look at. One caveat is that a lot of these formulas, what you derive at and what these Yahoo Finance or these professional analysts derive at might not necessarily be the same, because their definition might be different. Like for example, earnings, right? Like there's EBIT and then EBITDA, right? EBITDA sounds like da. Anyway, EBIT versus EBITDA, right? EBIT is earning before interest and tax, right? So before you pay, before you calculate interest and tax, that's how much you make, right? EBITDA DA. So EBITDA is the same, but you take in depreciation and amortization. So if you have like a factory, right, or if you have debt, so that's what D&A refer to. So the reason why I tell you this is because people's definition of earnings, right, could be net income, could be EBIT, or it could be EBITDA. Now, like Yahoo, I think generally are doing a good job. I don't know. I mean, somebody could tell me otherwise, but when I see like these people doing analysis, and the numbers, like they vary hugely, right? So it all depends on which number you use. So stuff that I'm showing you today might not necessarily be the one that Yahoo Finance shows you, because number one is the formula, and number two is what time frames are they considering, right? Like, are they doing past 12 months? If they say 2021, so it's almost end of 2021. Are they saying past 12, trailing 12 months? Or are they saying 2021 since beginning of this year, so January 1st to now? So it's kind of like, you can kind of fudge the number, so to speak, right? I mean, this is why a lot of accounting is like very vague, and it's very subjective. That's why it's sort of prone to a lot of scams and stuff. So the one thing that you got to take away is that whatever you decide, you have to just stay consistent. Like if you do the past 12 months, do the past 12 months for everything. Like don't just Yahoo, you decide to do the past 12 months, and Microsoft, you decide to do like from like the calendar year. Like you can't do it like that. Otherwise your numbers will look kind of funny, right? So just stay consistent. So when you do look at Yahoo Finance, you know what, put in the comments below if you think the numbers are like consistent throughout, meaning that they take the same time frame, they take the same period, same definition, because I just assume that they're same, because I'm not going to go through all this data and then just kind of verify, right? What's the point? I don't work for them. It's not like I'm doing free work for them. So I think I will stop here. We're going to get into that to start doing the calculations. If you are rusty on pandas, watch the previous, I don't know which episode. I think it's episode like 4 or 5, where I talk about a lot of this like iLoc stuff. Just make sure to like brush up on it. If you don't know, just download the Jupyter Notebook so you can actually see what I'm doing. But anyway, you can just follow along. It's relatively easy. Anyway, that's it for this video. If you liked it, make sure to thumb up. Okay, that's our currency. Okay, that's like how you pay us and say thanks for this cool video. Make sure to subscribe if you haven't. If you got value out of it, please comment. If you have questions, please comment, because a lot of this stuff I don't know what you guys want to see, because there's like a billion ways to do things. If you don't tell me, I'm just gonna assume that what I'm doing is okay. So anyway, that's it for this video. I'll see you in the next one.